Welcome everyone to our July freight market update. And it's starting to feel like we're saying sort of more of the same, time to keep on waiting. So starting us off with where the dry van spot market pricing is at, there was a little bit of excitement in June and July, especially the start. We were seeing spot rates going up, but every time DAT has released a new metric for July, we've started to see those spot rates tick down a little bit. Looking at the left, there's still not too much excitement. We're at about $2.08 a mile right now as the time of filming. That's still below the $2.15 we were at in January. And when we look at the broker buy premium relative to spot rates, it's about 16% at the moment. That is still solidly in kind of blah pricing territory, not suggesting that we're going to see any type of sudden market shift coming. So I do not feel 2024 will be 2017. That is for sure. It feels more like 2016 again. In terms of trucking demand, the trucking ton mile index has continued to pick up sort of softness for total freight demand. That data is through May, but that is very consistent with what we've seen Heartland Express report, certainly JB Hunt reporting, and Martin as well, where they're all saying, freight demand right now is just not that strong at the moment. Even if you look at Old Dominion freight lines, yeah, shipments are up 3% year over year, tonnage is up 2% year over year, but that is a fairly easy comp right now because Yellow was still in business at that point of time last year. And so right now it seems like we're probably off the bottom a little bit, but we're just moving along the bottom of this trough right now, still looking for some type of demand catalyst to emerge. And speaking of those catalysts, we just got the GDP data released for Q2. One of the series I take a lot of look at is real private fixed investment in residential structures. That's all new single-family housing starts, all multifamily housing starts, and importantly, all home improvements, so capturing that additional piece. What you'll see for that most recent data point is seasonally adjusted. We were flat with Q1. We're up ever so slightly from where we were in 2023, but we're effectively at 2017 levels right now. We're down almost 15% from those highs that we were at in 2021, late 2020, and then the first quarter of 2022. So without, sort of a spike and sort of unseasonal increase in housing activity, it's hard to see the market changing. A lot of this is because the Fed has kept interest rates higher for longer than we expected. The second chart is showing industrial production for drilling of oil and gas wells, so fracking activity. This is taking into consideration not only rig counts, but also the average depth of wells. Key thing to focus on right now is we are trending down at the moment. At best case, we become flat. Historically, if you have weak housing activity, so you're not seeing growth, and you have fracking trending down, due to the derived nature of demand from both of those sectors, it's very difficult to get excited about demand conditions for the overall trucking sector, especially sort of this industrial side of things. But many of you watching are saying, but how can this be, yet we had a much better than expected GDP reading? The one thing to keep in mind is how different sectors of the economy contribute to GDP. Sort of the freight-centric sector of the economy, if we look at, mining activity, agriculture, construction, manufacturing, and wholesaling, retailing to a little bit lesser extent because that product's already on the shelf and still the vast majority is people coming to the store, so the transportation's taken care of. But if you combine ag, mining, construction, manufacturing, and wholesaling, you're at like 25%-ish of the economy. So you can have the rest of the economy doing okay and still have positive GDP readings, even if we're still stuck in blah conditions. Right now, we are looking at an interest rate cut in September. That's probably too late to really get any type of, construction boom going. Gas prices right now, oil prices have been trending down. That's not going to encourage fracking. So right now, I'm still seeing sort of soft demand conditions playing out through 24. 25, we do have the potential for nice increases in demand. We are seeing some of the public carriers saying that. So right now, I tell you, we're still kind of riding the bottom of this trough from a demand standpoint. We're hoping for something to give us a little bit of spike, but I just am not really encouraged right now by what I'm seeing for the rest of 24.